Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Good afternoon. I'm Danielle Nesel from BMO Exchange Traded Funds. Thanks so much for joining us on this Friday afternoon. It's sunny where I am. I hope it's sunny where you are too. Spring is certainly on the way. Before we get started, just a reminder to everyone, today we are not providing you any advice. We are not providing you any recommendations. This session is all about providing information on markets, information on ETFs to help you, the investor, make the decisions that are right for you in your portfolio when managing your investments. And our guest from InvestorLine is here today. The same goes for them. We're not providing any advice or recommendations. This is all for information use only. Well, today's session is on income investing, and here to help us break that down is Mark Rays. Mark is the head of product at BMO Global Asset Management. And from InvestorLine, I have Hakan Pikyamorta. He's going to talk to us a little bit about a promotional offer. But before we get to that, I'd like to remind our audience members, please subscribe to our YouTube channel. So we set this up this year. This is giving you guys the opportunity to get all our shows. You can watch them on demand at any time that works best for you. Click subscribe. It would really help us grow our content and bring you more sessions in the weeks to come. Right before we jump into things, I just want to give you your 1-minute ETF update. So thanks to our friends at RBC Capital Markets for sending this data along. So when we're thinking about innovation stocks and growth stocks, which have certainly sold off in 2022, given those rising yields, ARK Invest was a big manager out of the US and a very popular suite of ETFs that a lot of investors at home are looking at. They are starting to see inflows again in February and March. So what does this mean? Perhaps some investors are seeing maybe a bottom for this asset class, maybe seeing good valuations at this point. But certainly after several months of redemptions, we're starting to see flows go back into these types of ETFs. So something interesting to look at. Now, Hakan, I'm going to pass it off to you to tell our audience members about this great promotional offer that InvestorLine has.
Thank you, Danielle. And I am a huge fan of the Market Insights webinars. Today, we have two great promotions for our audience. Our award-winning self-directed platform. Open up a new self-directed account and get $4.95 on equity and non-commission-free ETF trades. While opening up the account, please use the promotion code INVESTSMART, and you will get $4.95 on equity and non-commission-free ETF trades for 90 days. Our second promotion is for our digital advice platform, Advice Direct, and you will receive up to 20% off the fee, advisory fee, and can get up to 2,500 cashbacks. So these are great offers, and the code for that would be digital18. If you can go to the next slide, please, Danielle. At BMO InvestorLine, our mission is to empower Canadians to make smart investment decisions, and here we have a great tool in our learning center. Please click on the link below and you will have lots of videos and articles about how to make decisions smarter and educate yourself on investment decisions. Now we're going to talk about our free ETF trading trend. Is a growing trend. I'm sure many investors are pleased to hear that BMO InvestorLine's announcement about free trading on 85 ETFs, with now 8 firms offering different versions of free trading. Let's dive into our approach. Next slide, please. We offer 85 ETFs from the 3 largest providers in Canada, Vanguard, iShares, and BMO. These ETFs accumulate for half of the AUA in Canada. We select ETFs with the highest trading volumes and the high liquidity, providing options to cover the full spectrum of investors. The new suite of non-commission free ETF trading covers a broader range of asset classes, geographics, management styles, and popular themes for the largest ETF providers. There are lots of benefits for free ETF trading, just to name a couple: portfolio rebalancing and regular contributions. We're getting lots of interest from our customers and clients about ECG ETFs, and these are also part of the free ETF trades. Thank you, Danielle. Next slide, please. Just to remind you that our award-winning soft-target platform promotion code is InvestSmart, and our digital advice platform's promotional code is Digital18. If you have any questions, please feel free to reach out to me on my contact information below, or go to your local branch and ask for investment representative. Thank you, Danielle.
Thanks so much, Hakan, for showing us those promotional offers. That was great. Now getting to the main session of today's show. So we're talking about income investing. A lot of investors have been sending in their questions around this topic and why. Well, if we look at the data set here, yields in both Canada and the US, they have been dropping over the last 20 years. And it's a lot more difficult for investors to find yield in the market. So historically, looking back at government bonds, this is a risk-free asset. And this data set showing us government bonds were yielding over 5%, even almost 6% way back in the early 2000s. Well, today things are looking a lot different. Investors are getting very, very small yields out of fixed income assets and are starting to have to search elsewhere to supplement income needs in their portfolio. So we're going to get to all of that right now. Mark, I think one of the most popular type of ETFs that investors look for income are dividend ETFs. Can you talk to us a little bit about what is a dividend ETF, what kind of companies are in it, and maybe the considerations investors should make when comparing different types of dividend ETFs?
Sure, thanks Danielle, and thanks everyone for listening in today. So dividend income ETFs, very popular right now. Income-oriented investors, of course, looking at the bond market, seeing rising yields, seeing higher inflation, probably struggling a little bit on that side of the book. So looking to earn more income off their equity portfolios, and certainly dividend stocks fit the bill there. So you're looking at companies that essentially are paying a dividend, at market levels or above. Typically larger, more mature companies, obviously cash generative income statements. So these are the type of companies that weather market disruptions quite well. So that's another bonus of dividend income investing. And when you look at the ETF market, most typically it's split regionally in terms of dividend ETFs. So you could have a Canadian ETF, a US ETF, international, or even global. That helps with overall portfolio construction. But I would pause and caution everyone to just make sure you understand how the dividend strategy approaches the market, because they can be quite different. I think you want to avoid those types of ETFs that are extremely high yielding in terms of just chasing yield. I think you want a total return growth story attached to the dividend story. So when you look at these dividend strategies, a few things to think about. Are those dividends sustainable? Are they growing over time? How long have the dividend growth and payments been analyzed? And as well, how does the ETF weight to dividend stocks? And that's an interesting one, because the more you weight to yield, the more you might be increasing your weight to companies that are underperforming on price. So an example we can give you with the BMO ETF dividend methodology, we look at a positive 3-year dividend growth rate. We look at a dividend payout sustainability measure over 5 years, and we give a greater weight to stocks that score highly on growth rate and sustainability, and we're looking at dividends paid. So again, looking for large and mature companies. So I think that's quite important to look under the hood with these dividend ETFs, but they're a great portfolio tool right now for income-oriented investors. Thanks, Danielle.
Thanks for talking us through that, Mark. And I think you make a great point. It's not just like an S&P 500 ETF where, you know, each provider has one and they're all built the same. With dividend strategies, investors really need to start doing a little more due diligence and a little more research on how is that strategy working? How is it picking stocks? Are those dividends growing and are they sustainable? Two big important points. Now, kind of going further into the yield environment, we're seeing also a lot of popularity in covered call ETFs. So Mark, maybe you could just introduce us to the investors that might not know, what is a covered call and how does it work to generate yield?
Sure, thanks, Danielle. And so covered calls, which we also call enhanced income ETFs, quite simply starts with a basket of securities, but then writes call options on those securities to generate additional yield from the portfolio. And so what you do is you write a call option, typically out of the money, where you earn a premium from doing so, and that creates additional yield off the portfolio, with the trade-off being, of course, that the stock return above where you've written that call option, you would no longer be participating in, as the call would cancel out with the underlying security. So overall, these are great strategies for adding additional income to the portfolio. And then depending on how you approach the covered call strategy, there's different ways to look at that in terms of ensuring that you still have growth in the portfolio at the same time. But a great way to generate additional yield without adding extra risk to the portfolio.
Now we have our team of portfolio managers who are writing these call options on a bunch of different portfolios for several different ETFs. So Mark, maybe we'll dive a little deeper here. Can you tell us then the benefits of using a covered call ETF rather than just trying to write these on your own? And then considerations when comparing different covered call ETFs, because I know a lot of them are built differently as well.
Sure, thanks, Danielle. And as I mentioned off the last slide, what you're doing is you're adding those option premiums, so those call option premiums, to your dividend income to create an enhanced cash flow. And when I think of these types of ETFs, they really are a convenience tool for investors. If anybody's dealt with options on their own, you know, they're time consuming. There's quite a bit of operational work. You're always resetting the portfolio. You might get called on it from time to time. So there's a lot going on there. Whereas if you do it just with an ETF ticker, that's all taken care of for you. So to me, it's a real convenience tool. Other benefits, certainly tax efficiency, because those call options are taxed on the basis of capital gains. So of course, capital gains are taxed at a lower rate than interest income or even dividends. Lower volatility as well. While you still have exposure to the stock price and can move up and down with it, those call option premiums provide a slight buffer against losses on underlying securities. And then to your last point, not all covered call ETFs are created equal. Similar to dividends, I think you have to realize how the provider is approaching the strategy. And the most important thing is to make sure that the portfolio has room to grow. In other words, you don't want to be using up the invested capital to increase the yield. So things to think about: how far out of the money are the calls being written? So obviously the further out of the money, the more room for the portfolio to grow. How much of the portfolio is being written on? So of course, the lower the percentage, again, the more the portfolio's room to go. Is there an underlying dividend strategy? Are those dividends sustainable? Or is it something where you've gone into a high risk area of the market where you're probably going to get called out every once in a while? And then of course, always think about the underlying exposure. So where is the portfolio focus? Is it a regional ETF? Is it a sector ETF? Is it higher volatility, lower volatility? Just like anything else, always look at what the underlying portfolio is. So if I think about BMO ETFs, we do write on only half the portfolio. We write out of the money on short dated options. So that gives the portfolio lots of room to grow. Thanks.
Thanks, Mark. And another point I want to highlight that you mentioned is look at the types of stocks that strategy is writing call options on, because of course, more volatile stocks that are a bit riskier can get higher premiums. But again, you're adding that higher risk equity exposure as well with an ETF that might be writing calls on those types of securities. So lots of things to research on before adding a covered call ETF to your portfolio. Now, sticking with the dividend theme, we've talked a lot on the show about adding a sector ETF to a portfolio for different reasons, to skew to take advantage of a certain macroeconomic landscape. But it's also a way to get a little bit more dividends. Some sectors pay higher dividends than others. Mark, which sector ETFs or which sectors are you seeing higher dividend yields right now than the broad market?
Sure, thanks, Danielle. And yeah, you can go for a dividend strategy which covers the whole market, or you could go towards a sector if that sector happens to be a higher yielding sector. So things that come to mind are REITs, utilities, banks. Certainly right now, a lot of interest in the banking sector because of the overall returns in the market. So not just the yield, but the total return, where banks typically benefit in this rising yield environment. REITs are an interesting one as well because they tend to have a tax efficient yield from their underlying securities. So anyone in a taxable account, certainly REITs are something to think about. Economically sensitive, so something to also be aware of. And then utilities, on the other hand, much more of a defensive sector, so a lower volatility sector with a higher yield. Just be aware with utilities that you do get a little bit more interest rate sensitivity with the portfolio. So those are sectors that I would think about. Another thing to think about is how is the portfolio weighted? With BMO ETFs, we typically equal weight sectors. The thought there being that the more concentrated a sector is, the more you want to reduce that security risk by equal weighting the portfolio. You do see some other ETFs out there that have some very high individual security weights. And then the other thing to think about is, again, with the underlying portfolio, how defensive do you actually want to be with your exposure in terms of growth orientation to the market? So again, utilities would be thought of as much more defensive, or something like banks, you'd be getting something equivalent to market returns, and of late, something above market returns. Thanks, Danielle.
Thanks, Mark. And maybe I just want to just quickly touch on the relationship between a sector or a stock price yield and its stock price. So if you're thinking about yield and stock price, when a stock price goes up, typically that yield number will go down, or if the ETF price goes up, that yield number will go down. The yield will constantly be moving in relation to the stock price or the ETF's price, just to kind of remind the audience members on that, because even when I was building out this data set, I was surprised energy wasn't on here, but given the rally that the energy sector has had, the dividend yield now looks as a percentage a lot smaller than it has 6 months ago. So keep that relationship in mind as well. Now moving into a more hybrid space. So we talk about preferred shares as offering a little more income and tax efficient income too. Mark, can you talk to us about preferred shares and preferred share ETFs?
Sure. I think preferred shares is an area of the market that a lot of investors like because of the higher yield, but it's not just higher yield, but that yield on a preferred share is taxed as dividend income, where of course bonds are taxed as interest income. So you get an element of tax efficiency as well. And then you think about rising rates again and inflation, where you maybe want fixed income to be a little less curve sensitive. Preferred shares certainly fit the bill there. They typically have more credit risk, and as well with the market now being dominated by rate reset ETFs and rate reset preferred shares, those typically are shorter dated because they reset with the 5-year Bank of Canada note. So again, you're getting less exposure to interest rates overall. So you combine that differentiated return with the tax efficiency of the higher dividend payment. Certainly preferred shares have been catching the interest of investors, and they've actually performed extremely well through the market recovery, which is another reason why they've been getting, of course, a lot of attention. Thanks.
And now moving into bonds. So we started the conversation looking at equity solutions. Preferred shares are more of that hybrid that we talk about. Now let's chat a little bit about bonds. And I put a slide here, Mark, to talk us through discount bonds, because we're seeing a lot of investors ask questions about these. Can you talk to us about the benefits of discount bond ETFs and what type of account they could be held in?
Sure. Well, discount bond is a relatively simple idea, but a very effective solution for portfolios, in that what you're looking to do is simply select bonds that have lower coupons. So in other words, if the same issuer has two bonds around the same maturity date, and one has, let's say, a 3% coupon and one has a 2% coupon, you look to select the one with the 2% coupon. Why does that matter? Well, for investors that are investing in fixed income and taxable accounts, you are paying tax on the basis of the coupon of the bond, not the yield of the bond. So anytime that the coupon is higher than the yield, there's a little bit of tax inefficiency there based on that higher coupon. So if you simply select bonds with lower coupons, you take that worry away. So that's a big consideration in fixed income right now, particularly in taxable accounts. But as you see in the marketplace, we're generally in an area of low rates. Granted, they've been rising lately, but certainly overall we're in low rates. So across the fixed income market, you typically see that coupons, because of course those are historical bond issuances, are higher than yield to maturity. So it's not an ETF concern, it's a market concern. But anyone holding fixed income in a taxable account, a discount bond ETF is a great consideration to make that more effective. Thanks.
And another great proof point for using ETFs in general, as ETFs give investors access to these bond markets that they wouldn't traditionally have access to, and then getting portfolio managers' lens on it, having that ability to search out the bonds that are trading at a discount to make them more efficient in a taxable account. So thanks for talking us through that. Now, Mark, when investors are using ETFs to get income, and a lot of ETFs pay a monthly distribution or quarterly distribution, what are the key dates they need to look at and think about when they're expecting those cash flows to come into their accounts?
Sure. Well, there's a few dates that certainly play an important role in the payment of distributions from an ETF. The first is the X date. So the X date is the X dividend date. So that's the first day that the ETF trades without the distribution. So if you buy an ETF the day before an X date, you'll receive the distribution. If you buy it on X date or later, you won't receive the distribution. Record date is simply a date that matters for settlement of securities. Typically because Canadian securities settle T+2, that just helps from a custodial basis to understand who's going to get the payment. But if you're trading on the exchange, you really want to focus on the X date and not the record date. The pay date, of course, is when you're going to receive that actual distribution in your account. So one thing to keep in mind, when an ETF pays a distribution, all else being equal, the price of that ETF will drop, assuming you've paid a cash distribution, because you've obviously paid out part of the value of the ETF to its unit holders. So between the day before X date and X date, if markets are flat, you would expect the ETF to drop by that distribution, and that's something that investors always need to understand, whether they're getting the value of that distribution or not. Thanks, Danielle.
Thanks, Mark. I pulled this example from our website at BMO ETFs, but all providers will include this information. They will publish this information on their website. So if you're curious about the next pay date or how many distributions per year you're getting or what that cash distribution per unit is, you can look that up on all ETF providers' websites. This is something else you can find on the ETF website. We call these the tax parameters, and Mark and his team worked really hard on getting these out for us just a few weeks ago for 2021. Mark, how does an investor read the tax parameters like this? And I put a couple different examples. I showed a cover call ETF and then a US dividend ETF. So how does one read this information?
Sure. Well, all this does is tell you the tax factors relative to the distributions that have been paid for the year. So for the first example, for ZWC, you can see over on the right-hand side, it's paid $1.25 over the course of the year. If you look at how that's been broken out, it's being captured between dividends at around 50 cents and return of capital at around 75 cents. That return of capital is on the basis of tax efficiency on the call writing, where of course the calls are treated on gains and losses mixed in with the underlying portfolio sales. But at the same time, when you get rising markets, you typically see the calls move into the money. So that creates tax efficiency for investors. So that's the first. To the second is a DY. Again, we can see the total payment over on the right side at 91 cents. Here we don't see regular dividends because of course it doesn't hold Canadian securities, it's US dividend ETF. So now we see foreign income and foreign tax paid, which is a result of receiving US dividends, and then a smaller amount of return of capital alongside that for this ETF. So this is important for when you're doing your tax returns. Of course, you're going to get your T3 slipped, but if you want to look at the website in advance and see what you should expect to get on your T3, ETF providers make this available, somewhere in the neighborhood of the back half of February. Thanks, Danielle.
Great, that's really valuable information, Mark, to walk us through. So thank you so much for that insight. We got a couple questions, so they're gonna come your way, Mark. First one is, why are gas prices at the pump increasing now if oil and gas companies are locked into long-term futures contracts?
Yeah, I think this is just a classic supply and demand question. So of course, with everything going on in the world with Russia, Ukraine, certainly Russia is a major oil and gas producer. So there's definitely market concerns out there right now. And then as well, when you start talking about inflation and prints here in Canada that are now approaching 6% and over 7% in the US, commodities like oil will rise as a result of that inflation. So two factors, but for sure I would say the dominant factor right now is the Russia-Ukraine conflict.
So speaking of, another question's coming in on that. This audience member is asking, I know it's a rumor right now, Russia might be defaulting. We don't know if that's actually going to happen, but what sectors and regions might be negatively impacted by this?
Sure. Well, there's a lot of concerns out there, not just around Russia, but a broader contagion of emerging markets and even Europe. So that's the first thing you want to think about is your overall portfolio positioning. In terms of sectors, we just mentioned energy. Energy is certainly benefiting at this time. On the other side of things, where you might start to see some concerns depending on how this goes, is the more economically sensitive sectors, depending if this really creates problems in world markets. And in terms of regions, certainly emerging markets, we've seen Russian securities, marked down to zero. So that impact has already played through directly on emerging markets. The question would be, will there be impacts beyond Russia in emerging markets? And of course, then you have Europe or international markets that are certainly very dependent on Russian energy and whether there'll be some long-term impacts there as there continues to be disruption in the marketplace. So I think there's a lot of different ways that could go, but certainly a review of your portfolio would be appropriate at this time.
Thanks, Mark. Last question, is the use of cover call ETFs setting an investor up for paying higher taxes? I think they're worried about, this particular investor is worried about capital gains inclusion rates might change in the future. What are your thoughts on this?
Sure. So I think what we're asking here is, if gains rates goes up, does that impact cover calls more than other investments? Perhaps compared to fixed income, where of course you don't really invest for the idea of gains, it's more about income. There'd be a differential there. But relative to other equity investments, I wouldn't see any differential to a covered call. Certainly something with full market exposure could end up having higher gains. So it really depends how that plays out in terms of market returns. But I do think you want to think about the overall portfolio efficiency. And as we talked about with covered calls, because those call premiums are taxed as capital gains, you're getting essentially that 50% tax rate as opposed to dividends or interest income, which of course are taxed at higher rates. So even if that rate does creep up a bit over time, you're still getting tax efficiency via the covered call ETFs.
Thanks, Mark. So that's it for us today. I want to thank the audience for all your questions. We did get a lot on energy sector, so we're going to put an episode together in the coming weeks to talk about energy and energy ETFs, so stay tuned for that. Next week, we're going to break down the Canadian Bank's Q1 results, tie it back to ETFs, see how ETFs can provide exposure to that sector, and we have Alfred and Chris joining us to talk us through that. Thanks for joining us, and we'll see you next Friday.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.